Hello everyone. Welcome to the Stock Minds web channel. Investors often seek the rare combination of growth and value in a stock, a company that is both expanding nicely and still trading at a reasonable multiple. In that light, the Progressive Corporation, NYSE PGR, offers an interesting case heading into and following its Q3 2025 results. While the broader insurance sector is wrestling with rising claims costs and competitive pressure, Progressive has delivered strong top-line gains, solid profitability metrics, and a valuation that still looks attractive to long-term investors. In this video, we will dive into Progressive recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About Progressive Corporation. The Progressive Corporation is one of the leading insurers in the United States, best known for its auto insurance business. It was founded in 1937 and over time expanded into various lines of insurance, including personal auto, commercial auto, motorbike, recreational vehicles, and homeowners insurance. Progressive positions itself as a data-driven insurer, leveraging technology, telematics, direct distribution, and innovative pricing tools like its Name Your Price option, snapshot usage-based insurance, to compete more dynamically than traditional insurers. Progressive financial performance. In the third quarter of 2025, the Progressive Corporation delivered another solid financial performance, underscoring its consistent growth trajectory and operational strength. Revenue for the quarter reached $22.5 billion, marking a 14.16% increase compared to $19.71 billion in Q3 2024. Earnings per share, EPS, for the same period rose to $4.44, up 11.85% from $3.97 a year earlier, reflecting the company's ability to translate top-line expansion into profit growth. On a trailing 12-month TTM basis, Progressive reported revenue of $85.16 billion, representing an 18.35% increase from $71.96 billion in the prior year, while TTM EPS climbed 32.41% to $18.22 from $13.76, showing strong earnings momentum. The company maintained healthy profitability with a gross profit margin of 17.91% and a net profit margin of 12.58%, supported by efficient operations and disciplined underwriting. Return metrics remained robust, with return on assets at 7.6% and an impressive return on equity of 34.22%, highlighting efficient capital utilization. Progressive also continued to operate with a conservative balance sheet reflected in its debt-to-equity ratio of just 0.19, providing ample financial flexibility. Over the past 5 years, Progressive has grown its revenue at a 15.8% CAGR and its net income at 14.5%. Although the growth rate has slowed down, Progressive is still growing its business at a double-digit rate. Progressive Fiscal 2025 Financial Forecast. Looking ahead, analysts forecast 2025 revenue of $83.58 billion, a 12.31% increase from 2024's $74.42 billion, and project non-GAAP EPS of $17.82, up 26.61% from $14.07 in 2024. Overall sentiment among Wall Street analysts remains optimistic, with a consensus buy rating and an average price target of $273.79, suggesting 20.88% upside potential, while the highest price target of $350 implies an impressive 54.48% potential gain from current levels. PGR stock price performance and valuation. At the time this video was created, the stock was trading at $226.50 per share. Progressive stock has seen a 9.9% decline over the past year, underperforming the S&P 500, which gained 14.7% during the same period. Despite this short-term underperformance, the company has demonstrated solid long-term value creation, with its stock rising 134.6% over the past 5 years, compared to the S&P 500's 91.5% gain in that time. The stock also offers a 2.16% dividend yield, offering a modest income stream while holding the stock. From a valuation standpoint, Progressive remains attractively priced relative to its strong fundamentals and growth profile. The company trades at a price-to-sales PS ratio of 1.71 on a trailing 12-month basis and a forward PS of 1.68. Meanwhile, its non-GAAP price-to-earnings PE ratio stands at 13.98 TTM and forward PE of 12.87. Based on Fiscal.ai data, if we look at the valuation over the past 5 years, the forward PS is above the average, while the forward PE is below the average. The forward PE indicates a potential undervaluation, supported by Progressive's revenue and net income, which are still projected to grow at a double-digit rate. Progressive growth potential. Progressive growth prospect remains robust, driven by several factors. 1. Robust premium growth and market share expansion drive top-line momentum. Progressive Corporation showed strong premium growth in Q3 2025, with net premiums written rising 10% year-over-year to $21.38 billion and net premiums earned up 14% to $20.85 billion. This growth resulted from an aggressive market share expansion, especially in personal auto insurance, where policies in force increased 13% to 36.9 million. The direct auto channel was particularly strong, with 17% policy growth to 15.6 million, while agency auto policies grew 13% to 10.6 million. The commercial lines segment also grew 6% to 1.2 million policies, showing diversification beyond personal auto. Total policies in force reached 38.1 million, up 12%. Despite minimal and selective rate increases, Progressive gained over 1.5 market share points in personal auto insurance for 2024, now commanding about 16.73% of the U.S. auto insurance market, ranking second behind State Farm. 2. Multi-channel distribution strategy and product bundling expansion opportunities. Progressive's dual-channel distribution model blends a vast independent agency network of over 40,000 agents with strong direct-to-consumer channels through phone, online, and mobile platforms, providing market reach across diverse customer preferences. This multi-channel strategy offers an operational edge over direct insurers like Geico and agency-reliant carriers. Product bundling, especially auto combined with homeowners, renters, and property insurance via the Progressive Home Advantage program, drives cross-selling and enhances retention through multi-policy discounts. Average savings are 5% on auto premiums and over 25% for new bundling customers. Proprietary digital tools, Home Quote Explorer (HQX) and Business Quote Explorer (BQX) streamline quoting for both Progressive and competitors' products, generating steady commission revenues with limited underwriting risk. Although smaller than auto, property insurance offers big growth potential as Progressive expands in lower catastrophe risk states while reducing Florida exposure. In Q3 2025, total personal lines policies rose 13%, special lines 8%, and property policies 6% year-over-year. 3. Strategic marketing investment and competitive positioning against industry giants. Progressive's advertising spending hit a record $3.5 billion in 2024, up 187% from $1.22 billion in 2023, fueling significant market share gains. By Q3 2025, year-to-date marketing costs reached $2.4 billion. This aggressive spending, alongside preemptive rate hikes, enabled Progressive to outpace competitors like Geico and Allstate, which raised rates and limited new business. Iconic campaigns featuring Flo and Dr. Rick boosted brand recognition and customer acquisition, with personal auto new applications rising 32% from Q1 2023 to Q1 2025. However, competitive pressure is intensifying as State Farm leads with 18.87% market share. J.D. Power scores revealed challenges for Progressive, with a 621 rating below the 644 industry average, especially in trust and problem resolution. Balancing heavy advertising costs while controlling underwriting profitability is critical. Sustainable premium growth above 10% and combined ratios under 96% will be key for long-term returns. Risks to consider. While Progressive growth prospect is still good, we should be mindful of potential risks. 1. Intense industry competition. The insurance industry in which Progressive Corporation operates is characterized by intense competition. Major players such as State Farm, Geico, Allstate, Liberty Mutual, and others compete aggressively on pricing, product offerings, and quality of customer service. This fierce rivalry exerts pressure on Progressive's profit margins and challenges its ability to grow. To sustain its market position and expand, Progressive must continually innovate, leverage technological advancements, and differentiate its products while managing regulatory and economic hurdles effectively. 2. Regulatory and legal risks. Progressive Corporation is subject to stringent regulatory oversight, facing significant regulatory and legal risks that could materially affect its business. Changes in insurance laws, regulatory policies, or unfavorable legal rulings could influence Progressive's operations and financial performance. As the insurance industry evolves with climate risk disclosures, AI ethics, and cybersecurity compliance, Progressive must remain agile to navigate these complexities. Regulatory shifts may impact pricing flexibility, market access, and profitability, requiring vigilant monitoring and adaptive strategies. 3. Market and economic conditions. Economic downturns, changes in interest rates, and natural catastrophes significantly impact profitability. Lower interest rates decrease investment earnings, a crucial income component, while disasters escalate claims payments, straining underwriting performance. These dynamics introduce variability in Progressive's financial results, highlighting the importance of vigilant exposure management to mitigate economic and environmental risks to maintain stable profitability and competitive positioning in the insurance sector. Conclusion. The Progressive Corporation demonstrates a compelling mix of strong growth, profitability, and attractive valuation. With consistent revenue and earnings expansion, solid margins, and disciplined financial management, the company remains well-positioned to outperform over the long term. Despite short-term stock underperformance, its reasonable valuation multiples and strong return on equity offer appealing upside potential. Supported by positive analyst outlooks and a resilient business model, Progressive stands out as a quality growth value stock worth considering for long-term investors. But remember, this is not a financial advice. What do you think about Progressive? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching and see you in the next one.